Hi, I'm Susan Dziubinski with Morningstar. Every Monday morning, I sit down with Morningstar's Chief U.S. market strategist, Dave Sekera, to discuss one thing that's on his radar this week, one new piece of Morningstar research, and a few stock picks or pans for the week ahead. So, Dave, the big thing on your radar this week is earnings. A lot of mega cap companies report this week. What might that mean for the market?
Hey, good morning, Susan. So I think it could introduce some heightened market volatility this week, and that's really just based on two factors. So first, just based on the size of their market cap alone, large swings in those individual stocks can just have an outsized impact on the overall market. And secondly, the commentary and outlook that those companies provide during their call, that often sets the tone across their respective sectors. So if either earnings, and or guidance are different than what the market expectations are, coming into this week, we could not only see, big moves in those individual stocks, but across their entire respective sectors as well.
So now let's go through some of the notable tech and tech-related
Mhm.
companies that are scheduled to report. On Tuesday, I think we have Microsoft and Alphabet. What are you listening for there?
Mhm. All right. Well, first off, Microsoft is a three-star rated stock. It's had quite a run, thus far this year. So it's only trading at an 8% discount to our fair value at this point. Now, I would say most importantly for the Microsoft this quarter is going to be how that Azure business is doing. That's really been a key driver for Microsoft, for the past couple of quarters. Now, growth there has been decelerating, and any further slowdown there could pressure that stock. I think we also want to hear more about their strategy regarding artificial intelligence. Of course, that's been in the headlines the past couple of weeks, but really specifically about OpenAI and their Copilot powered solutions. And then lastly, we will certainly focus on their macroeconomic commentary and their customer demand outlook. Now, Alphabet, the parent of Google, is a four-star rated stock, and that trades at a 32% discount to our fair value. And I want to hear what their views are on how the impact of artificial intelligence could, impact their search business, as well as details regarding their own AI strategy. Now, otherwise, I'll be listening to hear if any kind of economic outlook is having an impact on advertisers, specifically at their YouTube division. And then lastly, I just want to hear details regarding their traffic acquisition costs. There's certainly been a lot of reports and news headlines that Alphabet might be having to renegotiate both with Apple as well as Samsung. There's reports that Samsung might move to Bing. So those traffic acquisition costs, guidance there certainly will be important this quarter.
So then midweek, we'll be hearing from Meta and Amazon. What are your
Mhm.
expectations?
Now, Meta is a four-star rated stock, trades at an 18% discount. And Meta has really had a huge run up this year. I mean, it's up, I think about 77% year to date. So I do think that, in the short term, with the stock up that much, any disappointment, could certainly send that stock down after earnings. And I think there's really three main things the market's going to be listening to here. So first, commentary regarding their advertising revenue and trends will be at the forefront. I think people are going to want to hear about the progress on their expense cutting programs, and then any updates on any outstanding regulatory issues.
And Dave, what about Amazon?
Oh, yeah. And Amazon. So Amazon is a four-star rated stock, trades at over a 20% discount to our fair value. Now, similar to Microsoft, Amazon Web Services has also been a key growth driver for the company. So I think what the market is going to be looking for is, has the growth rate at AWS continued to slow? And if so, by how much? Now, the other key growth driver for Amazon is its advertising business. Now, that has also slowed, but our equity analyst thinks it's holding up better than the advertising at Meta or Alphabet. And then lastly, just want to hear an update for retail sales trends. Have they begin to accelerate or re-accelerate in this case? I know our expectation from our research team is that they're expecting in line or better results there as well.
And then we have a couple of big oil names reporting later in the week,
Mhm.
ExxonMobil and Chevron. What are you expecting to hear there?
Sure. So both of those are rated 3 stars and trade pretty close to their fair value estimates. Now, I do expect that they're going to have a pretty strong quarter. Oil prices have remained pretty high, as well as OPEC, has announced, production cuts. However, I think both stocks being already pretty fairly valued, and really that's just because oil prices, while we do think that oil will remain high, here in the short term, we've held to our longer term oil forecast that oil will fall towards, $55 a barrel. And really what that is, that's our long-term estimate where we see supply and demand curve intersects with the cost of marginal new oil production.
So, Dave, let's pivot over to some new pieces of research from Morningstar
Hmm.
on three big names that reported last week: Tesla, Netflix, and
Hmm.
J&J. So let's talk about Tesla first. Morningstar reduced its fair value estimate on the stock from $225 to
Hmm.
$215. Walk us through that change and whether we think Tesla is a buy today.
Well, first, I'd note that following the sell-off that we saw, Tesla stocks actually moved back now into that four-star territory,
Mm.
trades at a 23% discount to our fair value. Now, as you mentioned, we did reduce our fair value by $10 to 215 a share, but I think that the market reaction actually overreacted following the earnings. So when I think about the reduction in our fair value, that really is just reflecting higher short-term margin compression as the company in the short term here is pursuing a volume over unit profit strategy. And so partially offsetting this is and again, taking a look at our notes from our equity analyst here, is we did increase our outlook for the energy generation and storage segment, and that reflects higher growth as Tesla builds out a new facility, in China. And while we did reduce that short-term outlook, the long-term view is unchanged when I think about the base case for the automotive division. So we still forecast that, Tesla will be able to, deliver 5 million vehicles, by 2030 annually. And we also do think that their cost reduction programs and their fixed cost leverage will drive long-term profit margin expansion. So actually, more specifically, we do forecast that their automotive gross profit margins will increase over time to 29% from the low 20% range that we're seeing this year.
So now we maintained our fair value estimate on Netflix after
Mhm.
that company reported. Walk through Morningstar's analysis here.
So Netflix stock trades pretty close to our fair value and is a three-star rated stock. And I'd say this is actually probably one of the quietest, most eventful quarterly earnings that I can remember out of Netflix in a long time. Now, the stock did slide a little bit after earnings. It recovered a little bit more the next day. But when I look at, what they reported, yes, their net sub additions, we're a little short of our forecast. We expect that'll be offset over time and that revenue will increase as Netflix continues to expand on its password sharing crackdown. So considering how volatile Netflix stock can be over time, personally, I would look for a greater margin of safety before I'd look to buy that stock. In this environment, we just see a lot of better, more undervalued opportunities for investors elsewhere.
And lastly, let's talk about Johnson & Johnson. We reaffirmed our current fair value
Hmm.
estimate there, but our analysts did note that drug pressures are mounting for J&J. So what's going
Hmm.
on?
So again, J&J is another three-star rated stock, trades pretty much right at fair value. Now, the results for the quarter in and of themselves were pretty much in line with our expectations, but our analysts did note that we believe that patent losses and slower new drug losses, will weigh on the longer-term drug outlook. Now, having said that, I would note that it is a wide economic moat rated stock, and that wide economic moat rating is really derived from its drug innovation and its pipeline. And that I think does help support our long-term evaluation. And when I think about J&J stock, but in and of itself, I do think it's appropriate for investors looking for, low uncertainty stock that pays a relatively high dividend. It's about a 3% yield right now. But again, I still think that I would look to buy stocks at a greater margin of safety. And in the healthcare space, we do see other opportunities out there, such as GlaxoSmithKline.
So let's move on to the picks portion of our program this morning. Dave, this week you've brought us 5 undervalued stocks you like after earnings. The first
Hmm.
stock on your list is Citigroup. Now, this bank has been a top pick from our analysts for a while. What's
Hmm.
the story here?
Well, all the mega banks have reported, and generally, I'd say earnings and guidance were either in line to slightly better than expected. And really, the biggest takeaway from the big banks is that while generally they have increased their loan loss reserves, those increases really are just bringing those loan loss reserves up to maybe slightly higher than historical norms. So at this point, I would say the banks really aren't preparing for a really deep or long recession. They're not looking for a surge in defaults or bankruptcies. And so that to me is giving me a pretty good comfort looking at this area. And I think also supports our economic view looking forward. So among the big banks, JP Morgan is a three-star rated stock. So that's pretty much trading right within that fair value range. Bank America, a little on the undervalued side at 4 stars, and Wells Fargo is a 5-star stock, but our preference here is still Citibank. So Citi is a 5-star rated stock, trades at a 33% discount to our fair value, and also pays about a 4% dividend yield. In fact, it's kind of one of the best ideas in the value category that we have, across our coverage. And part of the reason is that I would note that Citi does trade at a very large discount to its tangible book value.
Mm.
And in my view, from a value stock perspective, that discount to tangible book value provides both downside protection as well as upside potential. So we're really not projecting that much in the way of earnings growth with Citi, but we do expect that over time it will be able to earn its cost of capital, and that stock will then appreciate up towards that book value. Whereas all the other mega banks all trade at a premium to their book value right now.
So your second stock pick of the week is another bank, U.S. Bancorp.
Mm-hmm.
Our analyst called the earnings report average and expects that we'll shave our fair value estimate on the stock by $1 or $2. What do you like about the stock?
Well, we are still waiting for a lot of the other regional banks to report, but generally, U.S. banks reports were generally in line with results. Now, we did lower our full year revenue guidance, a little bit here due to lower expected, net interest income. But more importantly, I think here the real story is that the deposit base and the funding costs are roughly tracking out in line with what we would have expected. So the stock's currently rated 5 stars, trades at over 40% discount to our fair value estimate, and pays a 5% dividend yield. So our thesis among the majority of the regional banks that we cover is that, yes, they are under stress from declining deposits. They do have some stress from their real estate exposure, but we do think that stress will be manageable. Now, having said that, I will caution investors, one regional bank that we do have some concern on is First Republic. We had lowered our fair value estimate there to $3 a share after it had reportedly lost, 40% of its deposits earlier this past quarter.
Now, the next name on your stocks of the week is Charles Schwab. Now, there was nothing really eventful in the company's earnings report, and its balance sheet and clients base seemed fine. But our analyst expects a near-term decline in earnings and then a longer-term uptrend, and maintained our $70 fair value estimate.
Yeah, so I'd note, Schwab is one of a handful of stocks that we had highlighted, earlier, that we do think that they have enough of a different business model and do have enough other ways to fund themselves other than deposits that even after the Silicon Bank failure, we're very comfortable with these stocks and with these companies going forward. So as you mentioned at Schwab, first quarter earnings really didn't show any signs of really balance sheet distress or any client attrition. Yes, some higher costs as investors have been moving some of those deposits into higher yielding money market funds. But we're leaving our $70 fair value unchanged. Following the earnings report, stock's currently rated 4 stars and trades at a 23% discount.
So let's move away from financial services stock. Your next pick is actually Delta. Like the many other airlines, Delta has been enjoying some tailwinds.
Yeah, so following earnings, we did leave our $60 fair value estimate unchanged. The stock's rated 5 stars, and I think it trades at over 40% discount to our fair value. So we do forecast, strong bookings for the busy summer season, an improving cost picture in the second half of 2023. But also in my mind, I think Delta is just a good play on consumer behavior normalization, and even more specifically, the return of the business traveler as we do see a rebound in business travel, this year and next.
And then the last undervalued stock on your list this week is a tech name. It's ASML. The stock's up about 60% since its low last October, but it's still undervalued according to our metrics.
It is, the stock slipped a couple percent, but then rebounded right the next day. And I think really what's going on there is the market is somewhat concerned that the latest, round of export restrictions to China, could impede the company's ability to sell certain types of semiconductor tooling, into China. The earnings in and of themselves, were ahead of our expectations. Management did reiterate, its outlook for 2023 revenue to be up 25% year over year. But we also think that this is also a good play on the long-term growth in artificial intelligence, as ASML's equipment is used to make those specific type of AI chips. Stock's rated 4 stars and currently trades at a 17% discount to our fair value.
Well, thanks for your time this morning, Dave. Be sure to join Dave and I live on YouTube every Monday morning at 9 a.m. Eastern, 8 a.m. Central. And while you're at it, subscribe to Morningstar's channel. Have a great week.